you focus on the income and the cash flow instead, and why passive income is so important. I said, here's the thing. We've got plenty of investment deals that we do that are easily 10, 12% a year. So if you, let's go on the low end. If you have 1.9 million, how much is that per year at 10%? 190,000. What's your goal? 200,000 a year. I'm like, you got it.
Welcome, my fellow Flow Masters, to another episode of the Cash Flow Authority podcast. I'm your host, Chris Jansen, founder of the Flow Authority, and this show is for high-performing professionals who did everything right. The degree, the career, the income, but you still feel like there's just another level waiting. Here, we explore how real estate can become that next challenge worth building so that you can take ownership of your future and create a life by design. And today we're joined by a special guest, Mr. Chris Miles, who's very familiar with a lot of these cash flow concepts that we're going to talk about today and that we like to talk about on the show. He's the founder of Money Ripples and a cash flow expert himself who helps entrepreneurs build lasting wealth through passive income and financial independence. Chris is a formal financial advisor as well, and he now focuses on teaching cash flow investing strategies that break away from the traditional retirement models. So welcome, Chris. Really happy to have you today.
Same here. It's kind of fun to have the show of Chris Squared.
Chris Squared. There you go. Yes. And my coach's name is Chris too. Maybe we can have a trio Chris Cubed episode at some point.
There you go. Yeah.
Awesome. So let's jump right into kind of the theme, the cash flow mindset. What led you to focus on cash flow instead of the more traditional retirement planning models?
Well, that's a great question. Now I almost got this a different angle way you ask it that way. Now, obviously, as a financial advisor, I went down that route. I drank the Kool-Aid. I thought you set and forget it, save everything, spend nothing, save it forever, and hopefully someday you'll have something, especially if you put in mutual funds. And it's very much an accumulation mindset where you got to build it up, that miracle of compound interest, the eighth wonder of the world, because Einstein said so, even though he didn't. They like to misquote him as saying he did, right? And I bought into it until about 4 years in my career, my dad said, well, you're going to advise me at some point. So I sat down with my dad. Understand my dad was like post-depression era, penny pinching saver. And as I sit down with him, I look at his finances for the first time in my entire life. I see that he had paid off all of his debt, including his house. He was 100% debt free. He had been stuffing money in his 401k, getting his company match and everything like every good boy should. And he says, Chris, like I got to stop at some point. I've literally had strokes and heart attacks. The stress of this job is literally killing me right now. What do I got to do to retire? I said, Dad, you're 61 right now. If you try to retire today, you're going to need to die in about 5 or 6 years because you'll run out of money. I said, gee, thanks. That's not what I wanted to hear. What do I do? I said, I don't know. Keep working, save more. That's all you can do. And so he did. He literally worked into his 70s and until he was pretty much forced into retirement. And then until a few months ago, just passed away. The guy was out of money, completely out of cash. And that's the thing I realized, even in that moment, I said, man, this whole thing I've been teaching, this set and forget it mentality hasn't been working even for a guy like him. Who else is it not working for? But of course, at that time, I was like, I don't want to think about that because I didn't want to ruin my narrative, right? That what I'm teaching as a financial advisor doesn't work. A month later, I reached out to a friend of mine who I trained to be a financial advisor, but then he quit to go do real estate investing. And as we're talking, he starts telling me, Chris, my life is awesome right now. My dad and I have partnered on some real estate deals, and we've now doubled his income as a professor at the local university. I said, that's too good to be true. There's no way that's possible. You've only been in this, 5 months? No way. He says, Chris, how many of your clients are financially free where they don't worry about money? None. They all worry about money. Even the retired ones worry about running out of money too soon. Great. Good job, Chris. I didn't expect you to be honest, but there you go. Okay, how about this, Chris? How many of you guys as financial advisors are financially free, not off the commissions you're earning, but actually doing the investments you've been recommending? And this is the end of 2005. And I realized, I'm like, there's been guys working here since the 1970s. So over 30 years, and they can't retire either. I said, maybe none of them. There's your problem. And so that got me down this, taking the matrix red pill, so to speak, right? He got me tuning into real estate investors that were on an AM talk radio because we didn't have podcasts back then. And then I was even reading books like, not Rich Dad Poor Dad. I already read that a few times as a financial advisor, but I was reading things like Who Took My Money? which is also by Robert Kiyosaki, talking about why mutual funds suck, right? And I started to realize after a few months, I'm like, I either stay with this and just put my blinders on and keep going because it's my career, or I keep my integrity intact and leave. And so I chose the latter. I said, I'll never teach about money again. I'll be a mortgage broker, because in 2006, anybody could be a mortgage broker. And then also I'd be teaching ballroom dancing on the side and do a little stock trading. And that's what I was doing. And long story short, what I started to learn, coming back to your question here, was that it wasn't about how much money you accumulated. Because even if you accumulate that much money, and even 20 years ago, we were questioning the 4% rule everybody talks about, you can live on 4%. We were challenging that rule because we're saying, does that really work anymore? Nowadays, the other experts are already saying, no, the 4% rule is crap. The only person that's actually doubled down is the guy that created the 4% rule in the 90s. He's now saying, if you invest with him, it's a 5% rule, right? Talk about slick sales crap. But it's 3% if you're in your 60s, 4% if you're in your 70s, because people live longer and inflation's higher than the time segment. He took the 50-year time segment between 1926 and 1976. That ended right about the time we were taking off the gold standard, and inflation went higher, life expectancy went longer. So it's a 3% in your 60s. So the problem is you have $1 million and you have a whopping 30,000 a year you live on. You're living below the poverty level. You're a broke millionaire. Versus what I was learning from real estate investors is, hey, what if you loaned your money to real estate investors, let them do like a fix and flip or whatever it might be, and then they pay you 1% a month or 12% a year. And this is what shifted my perspective. And I was like, blew my mind. And I said, wait a minute. So you're saying if I give you $100,000, or in this case, that same $1 million, you're paying me $10,000 a month. That's $120,000 a year. Not living on $2,500 a month or $30,000 a year. I'm living on quadruple that. Same money, just better used because the income. And that's when I realized that cash flow is important, is that it's always about cash flow. Our sense of security isn't based on our net worth. Net worth is worth less unless it produces income. This is why I get people all the time that have $2 million, $3 million net worth, and they say, Chris, I can't even retire off that, because if I have 2 million, like I had a guy come, he had 1.9 million in the mutual funds. He's 59 and a half years old, wanted to retire, and his Vanguard advisor wouldn't give him an answer of when he could actually retire because he wanted to live on 200,000 a year. But at 1.9 million, you're living on less than $60,000 a year. And I told the guy, I said, listen, the reason he didn't tell you is either one, he doesn't know how to calculate it himself, or two, he's too ashamed to tell you that you probably have to work till you're 70 to do that, because you have to more than triple your money from where you're at right now to finally live on 200,000 a year in today's dollars, even not even factoring in inflation. I'm like, so you gotta have at least by that point, probably $8, $9, $10 million easily that you have to have. You have to quintuple your money in 10 years, hoping the market doesn't go down in the meantime.
Right.
And here's what he said. He says, Chris, I don't mind working till I'm 70. I just don't want to feel like I'm forced to.
Yeah.
And so I told him, this is where you have to change your perspective. If you focus on the income and the cash flow instead, and why passive income is so important, I said, here's the thing. We've got plenty of investment deals that we do that are easily 10, 12% a year. So if you, let's go on the low end. If you have 1.9 million, how much is that per year at 10%? 190,000. What's your goal? 200,000 a year. I'm like, you got it. I was like, even if you did nothing else, you save that money you made, reinvest it, you're going to be there the next year. You'll be able to retire next year when you're 60. I said, oh, but by the way, you've also got a property. You said you have investment property, right? Yeah, I'd make $300 a month net profit, but there's 800,000 of equity in there. Cool. We sell the property, take out the 800,000, you make 10% on that, and guess what? And let's even say that you lost 100,000 to commissions for the real estate realtor, right?
Yeah.
Well, that means you have 700,000 making 10%, that's 70,000 a year. Guess what? In year one, you make 260,000. You make over $250,000 a year, versus hoping and praying in 11 years, you might have 200,000 a year coming in.
Yeah.
He's like, holy cow. Like, I never thought of that. And that's really, Chris, that's really the crux of it, right? That's what woke me up to seeing hope and possibility where there really is none if you follow the traditional savings path that Dave Ramsey and Susie Orman and everybody else tells you're supposed to do, right? It's just BS.
Okay, so as you're talking, you're saying throwing around percentages. To me, that sounds like more of a debt deal, like a debt investment, right? You're investing money, like you said, lending money to other investors. There's also the option of equity. You can partner on deals and join on private equity partnerships. So what are your thoughts on that? Does that just depend on your age and where you're at and how close you are to retirement? Because obviously if you're retired, then the cash flow is even more important. So maybe you want more of a debt type of structure, but I could also see like a younger person who's trying to amass the wealth. The cash flow is still nice. It's still important. But if it's in your retirement account and you're not using that money to live off of, maybe the equity type of deal is better in that sense. I don't know. What's your take on that?
Yeah, that's the thing. For simplicity's sake, I used one example, but there are so many options that you have in the alternative investment space that no financial advisor will ever tell you about because, one, they're not allowed to with their licenses, and two, they don't get paid to tell you about that stuff. You literally lose money if you invest in outside sources like private investments, which is what hedge funds do. Hedge funds go into private investments all the time, and that's why the rich people make more money than you. But they won't tell you about that. They'll tell you, no, come in my fund because I'm going to make the 1% minimum per year, right? Or whatever it might be, whether you make money or not. And so you're right. There's so many different options. There could be equity. It could be debt-based. It could be business partnerships, all kinds of stuff, right? Even buying a rental property is an equity play. But that being said, it depends on what you're talking about, the goal, time horizons, and all that kind of stuff, right? Because you're right. I actually think there should be a mixture and a diversification among a lot of these different asset classes. And so in the case of this, like I had one guy that said, honestly, I love the cash flow, but I don't care. Next 5 or 10 years, just let my money grow. Cool. You could do that one of two ways. There are some places you could put your money that you could literally have it reinvested. It could be like a syndication where you pool your money with other investors and have a shared ownership together, like a business, but it could be in multifamily, which by the way, apartment buildings are coming back again. It could be in self-storage units. It could be in even, I'm blanking out, like I was going to say aged living, but a senior living. There you go. All that kind of stuff, right? There's so many different ways. Private equity, you mentioned that too. And so there are a lot of options. So there's growth plays and there's cash flow plays I talk about with people. So for example, lending your money, depending on the time horizon, you could just go on a single property, but you might get paid back 6 to 12 months later and saying, great, I got to do it again. Right. Or there could be a lending fund that is in a fund that they say, we pay you a contractual rate of return of this much. And now granted, could things go wrong in any of these situations? Yes. If I lend my money on a specific property, at least I have the property I could take back if they don't pay me back. Just like the bank takes my house if I don't pay my mortgage. And a fund, not as much, but you're more diversified. So you have this give and take of risk, right? But there are things like that too. That's a good cash flow type of play. Growth play would be like, for example, I'm in a couple of oil and gas, like mineral rights type of things where they're more of a business partnership. This is not explorative type stuff. I'm not talking about like doing the drilling and that sort of thing. This is like, they've already done it. They've already found the oil. Now it's just a matter of paying for the wells, starting to drill and do those sort of things and be able to pull out of the ground. And so you're leasing it like real estate in that sense. And you get paid whatever gets pulled out of the ground, no matter what. And that one, it takes the first year. Yeah, you might make 5-10%, maybe. But by the second, third, fourth year, they could get to 10+%. And it keeps growing as they drill more wells and do more things. And then more cash flow comes out of it. So like a business, it takes time to ramp up. So that's not something, if someone wants to immediately be able to hit their retirement number, that may not be the best play, right?
Right.
I'm in raw land partnership right now where that took a good few years, 3 to 4 years to really build up and ramp up. But $500,000 invested, now it's kicking off over $12,000 a month at this point. And it's kicking off that from like literally like over 50, 60 pieces of land that I'm getting paid on as people are paying me like I'm the bank. So there's so many different ways to do it. I have rental properties. I haven't bought some recently because the numbers haven't worked out very well. But man, pre-2022, I was buying rental properties and we were expecting 1% a month cash flow, right? 12% a year, not including appreciation, not including depreciation on our taxes and or paying down my mortgage for that fact, right? So there's just so many options. And depending on the market and depending on your goals, you can rotate between them to figure out where's the best place to have your money.
Nice. Do you personally, and then do a lot of your clients physically buy their own apartment buildings or their own real estate and actively manage that? Or are you really focused more on the passive side of things?
I started out that way where I'd have my own rental and I would be the property manager to keep every dollar I could.
Yeah.
But I learned I was a horrible property manager, right? And so when I lost everything in the recession, and when I say lost everything, really, I lost more than everything. I didn't go bankrupt. So I went over $1 million in debt and then had to pay that back.
Wow.
That's a whole other story too, right? Learned a lot of lessons about what not to do, which helped me do it the second time by 2016, much better. So I've been able to be financially free for over 9-10 years now. But I'll tell you, a lot of our clients, usually they prefer to be hands-off, though some don't mind being hands-on.
Yeah.
So I teach them if they're going to get rentals, do a turnkey rental, for example, where there's a property manager already in place. They handle it, which is great because for someone like me, I live in the western half of the US. Rentals are horrible out here. Just a ripoff. You're lucky to make anything unless you put this massive down payment, but then you make piddly on your money. Versus I go by about the Southeast or the Midwest, I'm going to make a much better rate of return because I'll pay less of a price and still get decent rent. And that's the difference. And using turnkey companies to say, hey, they're out there. I don't have to be on site to manage it. Somebody else is out there, boots on the ground to manage it, deal with the contracts and the lease agreements and even finding the renters, which is that in and of itself is a part-time job. You know? They can handle all that for me. So that's what I prefer to do. Most of our clients do as well. Most of them want to be hands-off investors. They say, I want my time back. So I'll take whatever's left over in that case. But there are some that do just love it. And that's why I tell them, if you're a person that actually loves the game, like you're saying, I love being hands-on on my property. I love being the person that gets the call at midnight, fixing whatever plumbing issue might be. Awesome. Then do what you love, right? Because you won't feel like it's work anyways. You're going to spend your time doing anything, at least do something you love. Me personally, that's not what I love.
Definitely, yeah. I relate to that for sure. I use property managers on all except one of my properties, which is out here in California. But luckily for that one, at least I had a tenant in there 2.5 years. They just moved out, so I had the joys of turning that over and getting it rented out. But yeah, luckily out here in California, it's very quick turnover. I think I had it a little bit high in the rent. I brought it down just $50, and all of a sudden, boom, I get all these inquiries, and literally within 1 week of the other tenant leaving, I had a new tenant in there. It's crazy. Wow. So I'm like, when I'm looking at a vacancy rate, I'm literally at maybe 1% on that because it was 1 week vacant in 2.5 years. So whatever that ends up panning out to be. But nonetheless, I was in there, I was doing stuff, fixing stuff. And I'm like, I'm not a handyman. And I hurt my back trying to rip out this tub drain. And I'm over here coaching other people. Don't do it yourself. Like you said, unless you love it. And even then you're trying to scale a portfolio, your time's probably better spent elsewhere. But there goes back to your point about West Coast properties not cash flowing. This one cash flows, but it really only does cash flow if I do it all myself and maintain those low vacancies. And I don't pay, because a property manager, for the very little bit of work that this one's been for me, it's just not worth, in my opinion, paying a property manager 10% of the high rents that we get out here to basically do nothing. In other parts of it's crazy actually. It's wild because I have a lot of investments in Wisconsin, and those properties are a lot older, so they are a lot more property management intensive. So they do more work, but then the rents are a lot lower, so they're getting paid less. It's just interesting. So it's like I can afford to pay them. I don't know. And also I wouldn't want to do it myself for sure, even if I was there. Yeah. Right. It's an interesting thing geographically how that works out.
Oh, it's a very different game. That's what most people just don't realize, because sometimes we just get into a money mindset thinking that we know the right strategy. And people don't realize that it's not, you got to go with principles first, strategy second, right? For example, like Dave Ramsey will say a principle is pay off your debt, but that's not it. That's a strategy. It's situational. You know, he thinks it's always the case, but I say a principle is something that always works no matter the situation. So for example, the principle that Dave Ramsey would teach is that it's to produce more than you consume, right? Or essentially earn more than you spend, right? That's the eternal principle. That's always true. You always want to be profitable. Yes. Even with your investments, you want to be profitable, right? Yeah. Don't bank on appreciation. Mistake of 2006 for me. Those kind of things, right? And so, like for example, I had a client that was in San Diego, and in his case, he was very laser focused, hyper super saver, like a lot of my Asian clients are. He was saving a lot of money. He was also trying to aggressively pay down his house and a rental property. And yeah, if I keep this up in 6 years, I'll be 100% debt free. And I said, well, let's figure out what that really means. I'm like, I'm open to this because it's not about the strategy. It's about the principle. What puts you in the best cash flow position possible? And so we looked at it and I said, okay, so if you pay off both these loans, you still pay tax and insurance, obviously. So you free up about $4,200 a month between these two properties. So that's $50,000 a year. That's not bad. I said, but I've noticed, one, you got a lot of equity in your house and a lot of equity in your rental property. By the way, what are you making on this rental property? Like after everything's said and done, he was managing himself, him and his wife were, they were profiting $200 a month. But there was 700,000 of equity in the property.
Wow.
So I told him, I said, listen, if you calculate the return on equity, not just your ROI, which you think you're getting, but the return on equity, because he was just looking forward to, if I pay this off, I'll free up $2,400 a month, right? So now I'll have $2,400 a month come in instead of $200 a month, because he's trying to free up the $2,200 mortgage. And I said, well, you could do that, but what if we sold the property? What if we sold it and invested it elsewhere? He did not want to do it. He was like, no, I got my blinders on. Like, I just pay off debt, save. It was like very Dave Ramsey mentality. 2 years later, he finally listened. He finally got his wife on board too. He was starting to listen more, but he couldn't get his wife on board. Finally, she said, you know what, let's sell the property. He sold it, got the 700,000 out because it actually appreciated a little bit more during that time, luckily in California. Sold it and took that 700,000 and did a tax-free exchange, 1031 exchange into 6 properties in Louisiana. So for one property, he was able to buy 6 babies, right? Or 6 houses, like Monopoly. And you're like, cool, I went from 1 house to now building a hotel and 2 houses on this property, right? So that's what he did. So now his cash flow is not 200 a month, it's 70 grand a year. Nice. Then he reinvested that 70 grand. So now 4 years later, which would have been this year, he would have paid off both mortgages. 4 years later now, he just told me, hey, as an update, I'm now about $10,000 a month net profit because I kept reinvesting and bought more houses. And now he is still personally managing them rather than doing turnkey because this is fun. He likes it. But even then, like still, it's very apparently different. Like he would have freed up $4,200 a month, but now he's got more like $10,000 a month coming in. And actually he's still going to free up a couple grand a month because he's about to pay off his house. He can still take all that money, aggressively pay off his house, and then he'll have $12,000 a month. And he never thought, even he told me, I never thought in my 40s that I would have this kind of freedom, that I would have this much going on, to where now he's what I call work optional, where he has enough passive income to work because he wants to, not because he has to. And that's the difference. You take that cash flow, I call it acceleration mindset versus the accumulation mindset. It's so different and so liberating. It'll shave off decades of pain and hassle by switching that mindset over.
Yeah, definitely. So I guess in that example, I know it's just an example, but if he has that much equity, what decisions go into, do you sell the property and pay the realtor commissions and go through all that hassle, reinvest it, versus doing like a home equity line of credit or refinancing or something like that and using the equity that way?
Great question. It's always about the numbers, right? At the end of the day, numbers. And also I factor in a little bit of risk too, right? Because if it's a home equity line of credit, it's a variable rate. It could go up. Now, some people are like, oh, I'll lock it in, but I have to make a principal and interest payment. That's now taking more cash flow away from you. So for me, at the end of the day is, what's my net gain from an income versus expense standpoint? My profit, right? Profit is where the freedom is. When I say cash flow, I'm really saying profit as in business, right? What's the extra left over or that you make in addition? Often, especially the last 5 years or so, when we look at home equity lines of credit, it's almost been better just to sell and then reinvest that way versus trying to do a home equity line of credit. Not that it's always bad, but almost every time it's okay, cool, we got the home equity line of credit, but if that interest rate goes up, which by the way, we saw happen 3 years ago or so, right? Interest rates started climbing, and man, those people that were relying only on that home equity line of credit, they just got their cash flow eaten alive, and now they're struggling, right? Versus those that just sold, they might have still had a little bit, they probably wouldn't have nearly the struggle, right? And that's what a lot of our clients saw was, even if there was softening in the rental market or anything like that, it didn't stress them out nearly as much as those that were saying, hey, my costs are going up, but my rents are going down. This is a bad combination.
For sure. Okay. That makes sense.
But I'll say this though, if I had the choice and all things being equal, let's just say I could cash it out and make the same return as doing a home equity line of credit, I would go with a home equity line of credit pretty much every time. And the reason being is that I want to make sure that I'm not necessarily using my own cash. I like to have my cash liquid and available for other things, right? If I'm going to use a home equity line of credit, I've encouraged a lot of my clients say, listen, you could take out little by little and try to pay it off like there's velocity banking. I teach against velocity banking. Okay. The reason is this is because of what I learned in the last recession. Because I was a mortgage broker. I was the guy that thought I could get to my equity whenever I wanted. And I watched firsthand, not just for myself, but my clients, when banks restricted credit. See, we haven't had a credit restriction for now going on nearly 15 years, right? Like they started to loosen things up in the early 2010s. I'll tell you an example. Like one of my clients, for example, she had an $84,000 home equity line of credit. She'd only used about $41,000 of it. And she was thinking, you know what? I'm thinking about doing an investment. I need to use some more money. Then all of a sudden, the next time I met with her, I am so pissed off right now. My bank just sent me a letter saying last week they cut my line of credit from that 84,000 down to 42,000.
Oh, wow.
So now she only has $1,000 available credit, right? And it actually inadvertently hurt her credit score because now it looks like she's maxed out her lines of credit. So her credit score dropped. Now she has no access to liquidity because she thought she'd just go and cash it out. And that's the same thing I thought, which is what cost me a lot of money in the recession, right? Once I couldn't liquidate assets, I was screwed. Same thing happened to her.
Right.
So now I've lost that opportunity. I can't even use it because there's no cash available. So even like during 2020, and there's all that uncertainty about what was going on, especially the first quarter, 6 years ago.
Yeah.
I told my clients, I did an emergency meeting. I said, listen, if you have a home equity line of credit, which were dirt cheap at the time, I was like, if you're going to use it, max it out. Put it all out. Because the good news is if it's maxed out, they can't cut your line of credit below what the balance is.
Yeah.
They can try to cut it back, but I'm like, if they're going to threaten to cut back, pull that money out now. Even if you just let it sit in cash for now and pay it back later, it's better to be liquid with cash than to have it disappear and then you can't get to it. And then if everybody's trying to sell their properties at once, which I think there will be a day in the near future that this might happen. If everybody tries to sell their properties at once, it's a bad selling market. Actually, let's be honest. Right now is even a bad selling market.
Yeah.
You try to liquidate, especially if you need the money.
Yeah.
A bad way to do a fire sale because people will buy it from you for so much less than what the property's worth. So that's where I've learned there's those nuances, right? Again, strategy is different than principle, but I've learned that I'd rather max out the line of credit, use that, and then keep my cash available versus use up all my cash, throw it all in my home equity line of credit, and then have the bank take it away from me without warning.
Since you mentioned this, now I have to ask, what makes you think, I guess, there's going to be a fire sale and everyone's going to want to sell all their properties at the same time?
Yeah, because we've had this everything bubble, right? We've had this inflation type of stress and affordability crisis, as they often mention. And this is the thing about banks is during every cycle, if you ever notice that almost every single recession or depression that we've had has often been due to stress from banks under stress, right? Every time. Even if you look at the bond market, still that was a financial institution. That was institutional money right there with banks that we had issues. I've hearing whispers, even from those that are literally trying to get refinancing or trying to sell properties and try to liquidate right now.
Yeah.
The banks are being very stubborn, very scrutinous, and they're dragging it out. And this is what they did to me. See, in 2007, I remember I bought a brand new home. I finished off the basement. And I said, all right, I'm going to do a cash out refi. So July of 2007, I go into that bank to do a cash out refi. They said, oh, you know what? We're getting a little bit stricter right now. Just raise your score up 2 points and we'll give you the loan. It's like, all right. So I basically have to make on-time payments for the next month. Got it. August, I go in and they said, oh, just last week, we just made some updates to some of those rules. If you do X, Y, and Z, jump through these hoops, then we'll give it to you in September as long as you keep your score up. So I did what they asked. And I'm thinking like, I just took a lot of my own cash and put it into that house just now because thinking I could just cash it back out, right? I had about, by the way, with the appraisal, I had about 150,000 of equity in this property now. So I'm thinking like I'm a genius because I put in less cash to get higher appreciation, right?
Yeah.
September rolls around. I said, can we get this done now? They said, we're sorry. We're no longer lending to those that have businesses. Basically, business owners don't get money anymore. I'm like, what? And then, of course, as a few months later, we got Lehman Brothers, you got Lehman Brothers, and of course, everything else happening, AIG, and all this stuff starts falling apart. And they do restrict the capital. And I saw it with flippers too. Flippers were having a hard time in the summer of 2007. Even though everybody talks about 2008 being worse, we saw it first in 2007 because things were getting tight quietly, not knowing that the banks were literally starting to fail.
Yeah.
And that's where I've learned, and I look for signs because it's not that history repeats itself exactly. It's never the mirror image of a certain depression or recession. But as Mark Twain does say, even if history doesn't repeat, it does rhyme. There are some common patterns. And we've had this huge party. And the bigger the party, the bigger the hangover. And we're at the point where right now, so many things are just, even the stock market doesn't want to go up anymore. Even the stock market's, I don't know.
Stagnant. Yeah.
Yep. And there's not even money to invest. Most money managers have about 1% of cash available to even invest right now. Everything's fully in equities. So they've already got their money in the market. They've already propped that sucker up with, and of course the feds keep printing more cheap money, which has kept propping the market up more. That's also driven up inflation in real estate. That's why I've been telling my clients the last few years, I said, do not expect any appreciation for the next few to several years. This has to be an income cash flow play. If you try to bend on appreciation like I did in the last recession, you will lose this time around. It worked in the 2010s. It will not work in the late 20s. So again, I could be wrong, but the Feds keep propping it up by just printing more money, which they are doing right now. But there's a point where just people can't handle anymore. They can't handle any more inflation. I think we're there. I think we're at a point where people are just like, they're exhausted. Their funds are exhausted. The only ones that are able to spend money are those that have assets they can cash out. But what happens when you run out of assets to cash out? You're screwed, right? And that's when you start to see things collapse.
Yeah. Wow. Yeah, I don't know. I think COVID really screwed us over in terms of financially as a country, right? Or more than just this country. But
I remember in 2019, we were having real estate meetings, and we were saying, hey, we're heading to a recession right now at the end of 2019. Brace yourself, be prepared. And then we saw COVID. We're like, oh, this must be the Black Swan event to spark this recession. But no. They had to bail us out, right? Literally, businesses, they bailed out individuals and started pumping money at us, depreciating everything, right? Even the minimum wage. I was screaming on my podcast 5 years ago saying, listen, raising the minimum wage will do nothing. People will be just as broke in just a few years. And where are we right now? Doesn't matter if it's $15 an hour or even more if you're in California or a lot of places, you're still broke. That's the reality, is that you can't get ahead by letting the government do stuff. Whatever the government touches gets more expensive, and that just costs you more money, not them.
Yeah, definitely. Wild. Okay, I got one more question for you, and we'll wrap things up here. So just
we're going to have a part 2 if this keeps going.
Yeah, I know. Definitely. And we'd love to have you on again. This has been great conversations, and lots of rabbit holes we can go down a lot further, I'm sure. But to kind of round this out, is there any words of wisdom, any piece of advice to give someone who's hearing this and they're like, okay, they're kind of sold on the cash flow idea and they really want to design a life that's built around cash flow, whether they're nearing retirement or they're trying to quit their job, replace it with some passive income? What advice would you give someone in that situation?
Yeah, there's a concept I teach in my book. I just released this book called The Work Optional Blueprint that came out just in November and became an Amazon bestseller and everything. Ironically, in budgeting and retirement planning, even though I'm telling people not to do retirement planning that way, but I'll take whatever I'll get. But in that book, I teach 3 basic things. That's really the premise of the entire book, broken up in sections in more minute detail, is get lean, get liquid, get out. Get lean, get liquid, get out. So get lean means start to really track your money. I don't care if you're using Rocket Money, Monarch Money, or a spreadsheet or a notebook. Doesn't matter. Okay. Start to see money coming in and going out. See what's really happening with your cash flow each and every month. This is the one thing that even good savers don't do. In many cases, someone might track their expenses, but they'll forget about the income side, and they forget that there might be some potential income generating sources that they aren't looking at, right? Savers do that. They fixate on expenses, ignore income. Spenders fixate on income and ignore expenses. A steward is the only one that's actually in an abundance mindset that says, I look at both. I look at the full flow of money. And so that's one thing, is start to look at it, and don't just live on rice and beans. Don't just go cut out that latte or whatever else that those guys teach. No, it's about how to be a wise steward. What's worth? Prioritize where you're spending your money, because there are things that you might spend your money on that's worth it to you, but not somebody else. And it's not their job to tell you if it's worth it or not. It's your job to say, is this productive in my life? Is this making my life richer or better? Or is it taking it away? Is it putting me in a higher stress environment? And that's situational, and that's a personal decision. So become a wise steward of money by getting lean. Get liquid means to have liquid available cash. Just like I was saying, all those warnings about having your money trapped in equity. Trap your money in 401k. That's a prison right there. You can't get to it unless you change jobs or quit. I don't recommend it, or get laid off. Don't recommend that either, right? So don't keep locking your money in prison, which is what every financial advisor makes you do. And that's why it's always long-term, decades down the road. Have money liquid and available to use, because that will save you more than keeping a crappy 401k that's probably going to lose money even if they get the match. Then you just lost double the money, right? So be careful. And then, of course, get out means once you have that money liquid, especially when you get into the 6 figures, right? This is hard for people. Some people are like, I got 10,000, I want to invest it. Do nothing. Save. Keep saving. I don't care if you keep it in a bank account. I don't care if you're I put a lot of my cash, like my lion's share of my life insurance, my whole life insurance policy, because I get 6% tax-free and it's 100% protected from lawsuits and creditors. So it's a much faster way to grow my money than put it in the bank at 0.0%. And then I get taxed on 0.0%. So I'll keep my money there. It's liquid, but then I'm going to get that money out. Once I get up to at least $150,000 to $200,000, now I can start diversifying in different places, start generating more passive income. And that's the key is you get lean, get that cash flow under control, you get that money liquid, then you can get that money out. So I'll give you a brief example. One client, they came to us because they said, yeah, like I've got 5 million sitting in Meta and Google stocks, right? They had a lot of money sitting there. They're high income earners and they were spending probably a good $24,000 a month in expenses. They're like, yeah, we want to get free. So help us in real estate. When I looked at the get lean part, I said, let's look at your cash flow. Let's look at every line item by line item where you're spending money. Looked at some of their stuff. I said, hey, you know what? If we refinance and do a few of these other money moves here, we can actually free up $3,800 a month. That's 45 grand a year with no money out of pocket.
Yeah.
So we did that.
Nice.
And I said, okay, next you need to talk to a CPA or accountant because I think you're overpaying on taxes. They were by more than $30,000 a year.
Wow.
So already we freed up like $75,000 without investing a single dollar. Then we also looked at one of their properties, zero cash flow, net profit, zero, with 200,000 of equity. Great. Maybe we sell that, use that money to make more money. We can make 2,000 a month off that. So we did. So now we're at like 100 grand a year with, again, no money out of pocket. Then we finally got to saying, great, now let's look at investing it. I said, based on what we've already done, because now we're at like 8,000 a month or 100 grand a year back in your pocket. Now we only got like another 16 grand to go. So if you make 10%, that's roughly, that means you could probably cash out 2 million of your 5 million in stocks, have 200,000 a year, you're there like this year.
Nice.
And that's what I mean is get that money, again, liquid. They had to liquidate their stocks to do that. So then they can get it out to then generate passive income because their stocks are doing jack squat for them.
Yeah. Yeah. Wow. Yeah. So you can kind of, some cases, restructure a lot of different things so that you might not have to do whatever it is you're thinking about doing. You can do something simpler or just literally move things around. I love that. And I'm not going to pretend I'm like an expert at this stuff like you, but I do look at all the time. I'm looking at where's my money going and how can I optimize this? And it's
That's smart.
When you start to get creative, it's really interesting. Wow. Okay. I could do this and literally wipe out, like I literally looked at this. I'm like, I could wipe out 5 grand a month on expenses if I just do this right here. But then here's the implication of that. So I'm just trying to weigh pros and cons, but it is really interesting just looking at those different, how can you get creative? How can you use different financial tools, infinite banking, velocity banking, like all these different concepts. It's really cool. And there's a lot out there. But like you said, you got to be careful. I've heard mixed reviews on the whole velocity banking concept. It sounds like you're against that. And I don't know. I've heard mixed reviews. You got to know what you're doing and what the implications are, good and bad, and just kind of weigh your pros and cons in each situation.
That's the thing. Like strategies change and are situational because velocity banking in a perfect world works amazing.
Yeah.
Right. It's awesome. I just don't believe that the world's always perfect. As long as the markets are great, as long as everybody's happy and everybody's making money.
Yeah.
Great. Once things get a little bit stressed, that's when that fails. And I've actually known companies that's their one trick pony. And literally now have lawsuits against them because they taught them cash out your equity, throw in these investments, and of course they gamble in bad investments too. And then it's just a whole crap show to put it simply in PG terms.
Yeah, for sure. And I've used the principles, the concepts of velocity banking. I have used those concepts before. I don't think I did it in a truly, I'm going to use this equity, like you said. I did take out a home equity line of credit. I used it on my on 2 different rental properties actually. And then I've kind of used that flow of money, cash velocity banking strategy to keep the balance down. I've reused it before. I use it more as a flex fund. I don't really think of it as I'm doing this because I want to save interest. I'm just doing it because it gives me immense flexibility. So, but what you said, I never knew that they could come back later and, I'm going to cut down your balance or the amount that we'll loan you by half. That's kind of scary. Yeah. But I don't know. At least right now, I think for my situation, I'm good because I know I have way more equity than what they gave me. The value's gone up. I pay down the mortgage, but that now at least I know to keep an eye on that. If properties start to depreciate at all, if anything like that starts to happen, definitely want to keep an eye on that. Or if rates start to skyrocket or anything like that, just rethinking that strategy. But
yeah, I think if there's anything you want to take away from this episode besides the get lean, get liquid, get out is focus on the get liquid right now. Because I really, truly believe that we're going to see more and more people say, crap, how do I get to my money? How do I sell off assets? If they're all trying to sell off assets, they're going to sell at a discount, right? Especially whether it's in real estate or stocks, you're going to see it tank as a result. You're going to lose those values. I'd rather be liquid now. So it's so cool. You do velocity banking, you can always make that payment, keep the balance from running up on you, but then take the profit, keep it liquid, because now you have optionality, right? Because now you have the option, you could pay off your mortgage or not, right? Or you use it somewhere else. So now you have a few more options, where if you always rely on just one strategy with one single exit, this is true even with any kind of real estate strategy. If you only have one exit, one way of it being successful, now you're starting to gamble a little bit more. You have to be careful.
Absolutely. Yeah, I've learned the hard way. People have told me before I listen to them, have 3 exit strategies minimum. And I'm like, I'm going to gamble. I'm going to gamble over here. This is fun. I'm going to do a little bit of this. That one example didn't work out for me. And so definitely
and that
I've learned my lesson.
Gives you wisdom, doesn't it?
Give me wisdom. I'm still paying the price. That's one where I won't go too much in the weeds, but basically that one deal is in a situation where now it's negative cash flow because the one strategy that I had didn't work, right? And not only that, but the value, I kind of paid premium value. Is at the height, I would say the height of the market, and the value in that market has gone down. So I'm not negative equity, but if I sold it, I'd have to pay the fees and all that. So I would be paying out of pocket. So it's okay. I could liquidate, but I'd be paying out of pocket. I could suffer some cash flow losses temporarily, wait it out. Eventually it'll go up. It's kind of like that balancing act with that situation. But
and if you have more liquid savings, you have the ability to weather that storm a little bit better than most people who sell and just have to be out of pocket and they lose money.
Yeah. So having all these tools to give you those flexibility is really nice, but it's better to analyze in the first place. Hey, let's have 3 strategies. Okay, if this doesn't work, what's option B and C? And actually thinking through, okay, if I was in option B, would I actually be okay with this solution? Is this profitable? And if it's not profitable, as long as you know that's your option B and you're okay with that, like if I knew that this would happen and I was actually okay with that, would be a different situation. But I didn't really think it through. Young buck just taking a shot, swinging the bat. But
you might hit a home run, you might strike out, right?
For sure. Awesome, Chris. I appreciate your time. Hey, before we wrap, where can people find and connect with you?
Money Ripples, whether it's at Money Ripples on social media, moneyripples.com, or our Money Ripples podcast. As I mentioned, we're going into our 13th season right now with the Money Ripples podcast, which you can find on any platform as well as YouTube.
Incredible. All right. With that, I appreciate it again, Chris. And hope to have you on another time. We'll maybe do more of a focused conversation on one of these separate side topics that we discussed today.
I love it. Yeah, let's do it.
Awesome, man. All right. Take care. Thank you. Thanks for tuning in to this episode of the Cash Flow Authority podcast. We hope the insights shared today help you take the next step toward optimizing your finances and building sustainable wealth. If you enjoyed this conversation, please take a moment to subscribe on your favorite podcast platform and leave us a review. It helps other entrepreneurs and investors discover the show. And don't forget to catch the next episode for more insights. Until then, keep mastering your cash flow.